Hello, corporate finance students, Business 630. This is Professor Hassey. Today is Sunday, June 20th. Happy Father's Day to all the dads out there. This is our introduction video to week number 3, financial statement analysis. This week we have our first case study. It will be posted tomorrow, June 21st, and it's due on Sunday, June 27th. It will be on chapters 4, 5, 6, and 7. And your reading for this week, which will be involved in our class lecture that will be posted on Tuesday, is Chapter 9, The Cost of Capital. So this week we're talking about financial statement analysis, chapters 3 and 12. And it's a key component of finance. What do we have to work with? What do our numbers tell us about the valuation of our company? Here's an introducing video into financial statement analysis.
Financial analysis is a very useful tool to understand how a company is doing. It's a bit like one of these Russian dolls, Matryoshka. You have a good look at it from all sides, and then you find out there's a level below it. You take a good look at that level, notice all the details, and find out there's a level below it. And on and on and on. Let's apply that idea to financial analysis. Financial analysis, Matryoshka style.
Financial analysis starts with revenue, the goods or services that a company delivered to its customers. Does the company have any revenue? Or is it still in its pre-revenue phase? In such an early stage of its development that the company does not have any revenue yet. In the pre-revenue phase, you can analyze the business plan projecting expected future results. Or analyze the burn rate. How quickly is the company burning through the cash they raised before they run out, as they don't generate any revenue? If the company does have revenue, how much did they generate in actual revenue? You find information about the company's revenue in its income statement. It's actually the very first thing on there, the top line. Start with the absolute amount and then check whether the revenue is growing or shrinking over the years. That's often called the V percentage, for variance percentage. How do you calculate the revenue growth versus prior year? Take the current year number, deduct the prior year number, divide the outcome of that by the prior year number, and deduct 1 from that outcome. Here's that calculation with the numbers filled in for our example. In financial analysis, both the absolute amount and the direction are important. A company with $1 million in revenue and 20% growth might be more interesting than a company with $2 million in revenue and no growth. Let's go one level deeper into revenue growth. Here's an example. You read a financial news headline about ABC Corp's double-digit revenue growth of 10%. The key financial analysis question to ask is, what was the company's underlying organic revenue growth? Organic revenue growth is the revenue growth excluding the revenue impact of acquisitions and divestitures and excluding the revenue impact of foreign currency fluctuations. For ABC Corp, total revenue growth is 10%, of which 1% was driven by favorable currency impact and 2% by acquisitions. So the organic revenue growth is 7%. That's the apples to apples revenue growth number you are looking for. Most publicly listed companies will provide it to you in the management discussion and analysis section of the annual report. Analyzing revenue and revenue growth. Your financial analysis takes you from the absolute revenue number in dollars to the revenue growth percentage, to the organic revenue growth percentage, and onwards to revenue and revenue growth by business, an analysis of price versus volume, and on and on and on.
With a Matryoshka doll, there's a starting point and an ending point. If only financial analysis was that easy.
From revenue analysis, we move to profitability analysis. We move down the line items of the income statement. Revenue minus expenses equals profit. There are various subtotals of profitability in the income statement. Gross profit, operating margin, earnings before tax, and net income. The most important one for financial analysis is operating margin. This is the margin or profit that the company generates from its operations. The starting question to ask yourself in the financial analysis of profitability is operating margin a positive or negative number in dollars? And how has it been developing over the years? Preferably, you would have operating margin growing faster than revenue, like in this example. 25% operating margin growth on 20% revenue growth, which means profitability is growing faster than revenues. Here's the income statement on its own. Here's the same income statement again, with each of the line items shown as a percentage of revenue. This helps to put profitability in perspective and provide a starting point for further analysis. Analyzing profitability. How much operating margin does the company generate? What is the operating margin as a percentage of revenue? Is the margin growing, expanding over the years, or shrinking, contracting? If you go one level deeper into operating margin, were there any unusual items included in current year or prior year results? Things like one-time acquisition related, restructuring, or litigation related charges. If so, it's a good idea to compare operating margin excluding these items for both years. Your financial analysis can then take you to the next level. Which of the expense line items is the largest one? How does the gross margin percentage look versus the operating margin percentage? How does the operating margin percentage of this company compare to its competitors? From profitability analysis, we move to cash flow analysis. Does the company's profitability translate to cash flowing into its bank accounts? Sometimes it does, sometimes it doesn't. The key financial analysis concept here is free cash flow generation. How much cash does the company generate that it is free to spend? And is that number higher or lower than last year? Free cash flow is that part of the total cash flow that is not needed for either operations or reinvestment into the company. This number can be calculated from the cash flow statement. The cash flow statement explains how much cash has come in and gone out during an accounting period, and what the sources and uses of this cash flow were. The cash flow statement has three sections: cash from operating activities, cash from investing activities, cash from financing activities. These sections are showing what the titles suggest. Cash from operating activities details the net cash provided by or used in operating activities. Customers paying the company paying suppliers and employees, that sort of thing. Cash from investing activities details the net cash used in investing activities, buying property and equipment, paying for the acquisition of a business. Cash from financing activities details the net cash provided by or used in financing activities. Transaction between a company and its lenders, like raising cash by issuing new debt, or paying dividends to shareholders. To calculate free cash flow, we need 1.5 of these categories: cash from operating activities minus capital expenditures.
And now for something completely different.
So far, our financial analysis has focused on the positive, the upside potential, revenue growth, margin improvement, free cash flow generation. If those are indicators of financial health, then their opposites must be indicators of an unhealthy financial situation, right? Revenue decline, margin deterioration, and free cash flow decline as indicators of an unhealthy financial situation. Well, that's only part of the story. The most important question in financial analysis might actually be, can the business survive in times of turbulence? How vulnerable or fragile is the company, particularly to unexpected events? That's where financial analysis of solvency and liquidity can help, but only for those elements of risk that are in plain view on the financial statements, as hidden risk is by definition hidden. Some of the answers are found on the balance sheet, the overview of what the company owns and what the company owes. The balance sheet example you see here on the screen has many of the line items you would frequently find. For example, what was the cash balance on the latest balance sheet? And how many months can this keep the company operating versus the expenses on the income statement? Cash is part of a larger balance sheet category called current assets. Cash and other assets that are expected to be converted to cash within a year. These current assets you can compare to current liabilities, amounts due to be paid to creditors within 12 months. The ratio between the two is called the current ratio, which when it is very low can give an indication of liquidity issues. A key solvency metric is the debt to equity ratio. The idea here is to take the total liabilities and divide them by the total equity. The higher the debt to equity ratio, the higher the financial leverage. You have now arrived in the world of financial ratio analysis, which provides a set of tools to analyze the relative financial performance of a company.
Here's some important financial analytical information and ratios and formulas taken from page 119 of our textbook, and I will post this sheet and we'll discuss this sheet in my video lecture for this week. Liquidity ratios, asset management ratios, debt management ratios, profitability ratios, and market value ratios. Somewhat similar with a little bit more detail from what the gentleman just described. So that's our introduction to this week number 3, financial statement analysis. We're going to be learning about determining the trends, the good or bad trends and analysis of companies relative to themselves and their history, relative to the market, relative to the industry and their competitors. That's our discussions for this week. In addition, case study work, which will be posted on Monday, June 21st. Look forward to seeing you or working with you again this week. Note my video lecture will be posted on Tuesday. Thanks, everybody. Have a great week, and we'll see you soon.